this and say hi to everybody.
It was just so funny.
David is one of our lenders.
I was gonna say, I don't think we've
This is
met
Johnny,
yet.
one of our new
Johnny
agents.
David Brown, very nice to meet you.
We're live, baby.
All right, we're live. I always feel like I'm like doing like a 360. Have y'all seen any of Nate Bargatze's stuff where he does the
I've
stand-up?
seen him, yes.
Where he's in the stadium
That's
where
amazing.
he's like 360. Yeah, I
That's
feel
one
like,
of my son-in-law, that's like his favorite comedian.
yeah, he's awesome.
He's
He's got a Christmas special out on CBS tomorrow night.
Oh my God.
Yeah. So I'm going to start talking because we're live. Thank y'all for having me. David Brown's here, Pacific Mortgage. We're just down the road on Oakland Avenue. Come by and see us sometime. I wanted to, so I threw this out to a couple of y'all. I won't name any names, Callie. Just for topics of interest that we might talk about. And I got some common themes and themes that aren't only just from you guys, but just in the market overall. So I thought we would chat through some of these topics, and please let this be interactive. I love to make this a dialogue and not a monologue. So investing, that's kind of the topic of this lunch and learn today. So we're going to talk about real estate investing and financing for investing. And I thought to kind of kick it off a little bit, I could tell my story a little bit. So I've been an investor for 13, 14 years. I became an investor by default when our family outgrew our condo, our 2-bedroom condo. We had 2 kids and 2 dogs, and the walls were closing in on us. And this was back in 2011, and it was hard to sell a condo back then because of just how hard it was to finance them, and just the state of a lot of the HOAs that we're in. And so we did what a lot of people do. We kept it, rented it out, bought our first house, and held on to it for a while. Ended up selling a couple years ago. But when I got that first rent check, I thought, man, this feels kind of cool. It's I think it was like at the time $800. My mortgage was like $500, and I was like, I think I could get used to this. So the lady 2 doors down was selling hers, and I had a fancy dancy home equity line of credit on mine. I thought, well, I can just use that as a down payment and buy another one. So I ended up doing that type of thing for about the next 7 or 8 years, where I would just, and backing up a little bit, back in 2000, about 20 years ago, I read this book by a gentleman named Robert Kiyosaki. Y'all probably heard of him, called Rich Dad, Poor Dad. They just talked about a lot of it had to do with real estate investing. Other people's money, OPM. And so that kind of lit the fire in me to want to do it myself. So over the next few years, kind of on average bought a condo a year. It was a lot easier to do back then. The prices were a lot lower. I got some short sales, did some creative things. Would always use like a line of credit or something as my down payment, and then kind of work my tail off to pay that off and free it up for the next one, or refinance or whatever. So for my first, I'm currently at 20 doors, and I think up until the last 3 or 4, I never used any of my own money for it. So it was always creative stuff by necessity. I used, for the 6 unit I bought, this is an Airbnb, I got some private money for that, ended up paying him back. So OPM, that's been my risky mode of investing all these years. So if you have an appetite for risk and ever wanted to talk more about my experiences, I'd love to kind of share that with you. And I love looking at deals, and so kind of looking at it and how do you put this together. What are the sources of money we can use, and even if it's maybe not me, I can. It's something I love to do, just problem solving, those kinds of things. Private money was one of the things that was tossed out. It's out there. I think a lot of times you can get better deals from private individuals than you can even get from a lot of banks. A lot of money on the sidelines where, people they want to help people out. I think they want to help investors. They want to help, people who are trying to get into investing. And so oftentimes you can borrow that money at maybe even less than what the prime rate is. Prime's 7.5 right now, I think. After this afternoon, it'll be 7.5, I think, 7.25. So,
Ew.
Gross.
Yeah, well, it was 8.5, so we're heading in the right direction. Matt, we had a deal not too long ago where there was some private money involved. Got into the house, did a loan to pay back the private lender, and everyone made a couple bucks, and the owner got traditional financing, and so it worked out great. Any questions on that?
Yes, actually.
Yeah.
On pulling out like a HELOC loan, what are the maximum rules on that? Like, is it like 80% of the equity that you have that you can take out?
Yeah, banks are different. So the question is how many, on HELOC financing, like a home equity line of credit, generally you can only get those on your primary residence. It's hard to get those on a rental property or a second home. Generally banks want to limit those to your primary residence. If it's not, they're going to call it more of a commercial line of credit, and then that's going to be a whole different animal. I think you'll see banks range from 80 to 90% on home equity lines. I've heard someone say at one point Eastman was doing 100%. I mean, I don't think they're doing that now. There's a range. Every bank has a different appetite. How they want to, what their credit culture is. I've been at banks where they would go up to 89.99%. I think once you get to the actual 90% from a regulatory standpoint, there's issues there. So 80 to 90% is kind of a common loan to value. So you take the value of your home, you multiply it by the 80 or 90%, minus out what you maybe already owe on the house, and then that's that loanable equity you might be getting. Now you're gonna have to qualify for the payment because there's gonna be a hypothetical payment associated with that. Most home equity lines are gonna be interest only. So now they may qualify you as if you were to term it out over a 15 or 20 or 30 year term. But the actual payment's usually interest only. So that allows for flexibility. HELOCs are really designed to be short-term financing. They don't want to see those evergreen. They want to see them go like this. So ideally, you do a draw, buy a place, maybe you put some sweat equity into it, increase the value, and then refi, pay that HELOC back down, and then free it up for maybe another purchase. So it's a great way to churn that money and build force appreciation and new equity. Does that answer your question?
Yes.
Okay.
Let's go ahead and do that investment property.
Yeah. When I was at a bank, we did, had some investors who wanted to do that. We might do a line of credit secured by real estate, but generally that's an annual renewal, which means annual fee, annual financial information you got to provide. It's not a fun. It's not a fun
And then
thing.
your portfolio loans, like kind of link stuff up, do like one big pool on them.
Yeah, we would do maybe like a loan secured by multiple pieces of real estate, and then a line secured by those pieces too. But then you also have to appease the regulators too. With we've got to substantiate the value is still there ever so often. So is that every year? Is that every 3 years? Every 5 years? Or it's they can. And then you tend to see clients mismanage those lines where they don't always use it for what they should. And then they don't always do what they say they're going to do as far as paying it back down. And so then you have to have a hard conversation. It's like, well, we're now going to term your line out. Yeah. So on the investor side, with what we do, I got to check the button. Let us turn this off. We do traditional rental property financing for 1 to 4 family units. So that's your duplexes, triplexes, quadplexes, single family houses. Could be a condo. We don't do any investment on manufactured homes. So if you have a client saying, hey, I want to buy this double wide and make it a rental property, they're going to have a hard time doing that. It's probably going to have to be maybe a bank or a credit union, maybe. And even then you may not get a 30-year term. It might be more like a 15 or 20 potentially. Single wides are even harder. So On the traditional financing side, we do those like, Fannie Mae, Freddie Mac. Generally for a single family house, we're gonna need 15% down. I can tell you though that interest rate pricing on 15% down rental property in the last couple of years has been horrific. The risk premium associated with that, I don't care how good your credit score is, if you're just putting 15% down on rental property, the price is gonna be terrible. And by pricing, I mean interest rate and discount points. So the points that go with that rate, which add to the closing costs. If a client can put that extra 5% or really even extra 10% to get it to 25% down, we see the pricing get so much better for clients on rentals. If it's a 2 to 4 unit, we're looking at a 25% down payment. Some investors are kind of surprised to hear that because maybe when they buy their first property, they want to live in one of the units, they can put 3.5% or 5% down. But once they move on to that next investment property where they're not going to occupy it, then they're really having to put more skin in the game, which ends up being a barrier for a lot of people. So that's kind of the traditional 30-year fixed way. We're going to look at the debt to income ratio of the borrower. We can even look at the proposed rents of the property they're buying. But there are limitations there. If their debt to income ratio is too high. So when we run into that, particularly with self-employed borrowers who maybe don't show all their income on their taxes, we'll look at what's called a DSCR loan. I'm sure y'all have heard of these. We've talked about it. It's been a big topic lately. It's a non-QM product, so it's a non-qualified mortgage. It doesn't get sold to Fannie Mae or Freddie Mac. There's investors out there on the back end that aren't Fannie or Freddie. But it means a little bit more risk because when we do those loans, we don't submit the first piece of income documentation, tax return, pay stub, anything. We're simply looking at mainly 3 things. We're looking at the cash that they're able to put into it. So most DR programs are going to be 20% down. There are some that are 25% down. First-time investors are probably looking at 25% down. So we're looking at, do they have the down payment? Do they have the credit? So we do look at credit score. Generally, 660 to 680 is kind of your threshold. I don't know that I've seen a program less than 660 on DSCR. We've brought in some in-house products for DSCR. I think our threshold is 680. We broker out to some companies that are like at 660. So now, if you have, I'm working on one right now. A couple from Florida buying in North Carolina. They have about a 665 credit score, and their rate's 8.25. Very much driven by credit score, and they're putting a big chunk down. So, but they have a business. They don't show much income. It's really their only alternative. So the third thing is the subject property. So it's going to have to appraise, and it's going to have to cash flow of at least in most cases a 1-to-1. So the gross rents up against the monthly housing expenses of the property. So principal, interest, taxes, insurance, any HOA dues if applicable. It's got to at least cover 1-to-1. The interest rate gets a little better, once you get to say 1.3-to-1. The way we determine that is the appraiser, when they appraise that property, they're going to do a market analysis of what the rent would be, and so they're going to do some research on the market rents. If they're already occupied, there's going to be some weight to that. But then even if they're vacant, they'll do an analysis so we can use the projected rent even on a vacant unit, as long as that unit is inhabitable. If the unit's gutted, then that's going to be a problem. So,
will you go into the below square footage when you're appraising for an investment for rental?
Yeah. So the income is going to be probably a bigger determining factor there versus.
Remember when we had that one in Bristol?
Was it an investment property? Okay.
And Danny, that below grade square footage wasn't counting for the rental.
Okay.
To appraise for the value that we had it under, remember?
Yes. Okay. Yeah. So below square footage is not going to be valued the same as above.
Correct.
For sure.
Yeah. So if it's an investment property,
Yep.
and you're running those numbers for an investor, and you're like, oh yeah, the rent could be this, but then when the appraisal is going to be completely different. if that's what it's based off of, with the appraiser that's going to the property to assess it for that type of loan.
What was one of the appraisal approach, cause I know there's a subject approach, income approach,
Yeah.
like, would they, what was this property, was it?
It was a split, it was just a subdivision in Bristol,
So it was a
but
single
two of the
family with a
bedrooms,
basement? So is the bedrooms rented independently? So it wasn't a true multifamily?
No, it was.
No, it was a single family house.
Yeah, it wouldn't be at that point.
Yeah.
I could be talking about the blood, but I wouldn't see that as a single family being able to be, it would be different if it was like a quadplex with 2 units that were a little bit below grade,
Yeah.
and then 2 above grade. They're just gonna look at the income, not gonna, well, we can't count this one because it's a little below grade. That's a single family home that was designed for residential inhabitancy that somebody has now used as income producing. So I think that's where they're valuing that of like, well, the person that's buying it, they're not, they can just live it, it doesn't have to be income producing.
Right.
Is that probably where it ran into?
Um,
or?
Well, I think they were renting the whole house, but Danny told, like, for the appraised value, for the
Yep.
type of loan that we had, he was not able to qualify the bottom part as.
And that,
I don't
and that's going to be
remember
the
what it
case whether it's from investment property or primary residence.
was. Right, right.
I think so. We're talking about value and we're talking about market rent, right?
Yeah, because we were running the numbers for the rent and it didn't suffice for the monthly payment. That when it appraised, because it appraised way less than what a rental standpoint was from Danny's perspective.
Okay. Okay.
Does that make sense?
Mm-hmm. Yeah. So single family houses, by and large, are going to be more based on comparable sales.
Yeah.
Right.
And there's going to be adjustments based on square footage and what's livable, what's not, or above grade and what's not. So I don't want to get too far into that because I'm not an appraiser. My little disclaimer there. But the point is that it all kind of factors in, and you can, as an investor, when you're buying real estate like that, you can account for that potential income that will help in qualifying for the loan.
Maybe pro forma.
Yep. And generally, we will use 75% of whatever that market rent is towards qualifying income. So now that's not DSCR. DSCR, we're looking at gross rents up against expenses. So two different underwriting methods. Any questions on that?
DSCR, does that look at your debt?
No. It's just the project. So no debt to income ratio. So and you're going to pay a premium for the rate, which is looking better than it has with rates. And this is a non-QM product, so it's not going to track exactly what mortgage rates do. But if the 30-year fix is say 7%, you might be looking at 7.5% or something like that. And then there's adjustments for things like credit score and the actual coverage ratio, how much you put down, that kind of thing. So
Does that make sense to why that's like such an awesome loan product to everybody? So like you could make no money but have cash in the bank and buy a cash flowing investment property. You could also be doing really good, be maxed out on your debt. Right? Say you're $1 million in debt, you make good money, have this awesome investment property that you see that's bringing in money, and traditionally you can't buy it as a straight investment because they're like, no, you're a little tight.
Yep.
With DSCR, they're just going to look at the performance of that specific unit, that property, so that way you can continue to add to your portfolio without worrying about your net income. You're going to pay, like you said, be more expensive, probably influence more expensive on your interest rate, but you have a cash flowing asset, it's cash flowing asset.
Absolutely.
One way we'll also help drive that rate down for borrowers too is DSCR, because it's a non-qualified mortgage. We can actually add a prepayment penalty of 1 to 5 years. So in a falling rate environment, it's not fun to think about. At the same time, every time you refinance, there's transaction costs, there's friction costs, and so there's probably an argument to be made that hey, if you held onto this loan for say 3 years. And then refi, you may be better off doing that, get out of your prepay penalty, and let rates come down to a point where then, it makes sense. As opposed to, rates dropped at a point, I'm gonna go ahead and refi. And then they drop again, so there's something to be said for holding that property for maybe a little longer, and avoiding, maybe multiple refinances. That's coming from a lender who makes money on refinancing. But there's a silver lining there, even if you have a prepayment penalty. And we're putting the one we're doing right now. It's I think we're doing a 3-year. We were able to get the rate down a little bit by doing that. I'm going to leave these here with you. So we wholesale with a company called Plaza Home Mortgage. Very large mortgage company. They only work through people like me that can broker through them, so you can't go directly to Plaza. But they have some very competitive.
So basically, we say we know a guy.
Yeah, well, yeah, we use them out of the scene, so all the paperwork to the client says Plaza on it, but also says us too. But we have they have a couple of very competitive DSCR products, and these are program snapshots that show, hey, based on your credit score, here's how much you need to put down, or here's the different guidelines. One of these you can actually go under 1 to 1, so you go to 0.75. So I'll leave these here with you. Might be worth thumbing through. Another question I got was VA loans. Y'all seen any VA loans lately? Has anyone asked y'all about buying a house with that has a VA loan on it and trying to assume that loan? Like, hey, this is an assumable loan at 3%. I'd like to assume this loan. That is possible with VA loans. So that was a question that one of y'all had. It's like I liken it to kind of like a unicorn, where you hear about them a lot, but you never actually see them. I don't know of anyone that's ever got one, but it happens.
You get got one as far as a assumable VA or just
Yeah.
an assumable period?
Assumable VA. So FHA loans are also assumable. You hear more about it with VA for whatever reason. The things that I learned in researching that is you really want to be careful if you're taking on both sides. If you're giving up a loan to someone, you want to make sure that your liability is released. Your liability is released, because if they default on that loan and they don't do a release of liability,
Absolutely.
then you are liable for that
So
loan.
how does someone go about qualifying to assume something?
Well, it's similar to just applying for a new mortgage. So you've got to prove, you've got to have credit that's credit worthy. You've got to have income. You've got to have assets, job history, stability, or whatever. However you would qualify normally. The biggest barrier we see and hear about is they just simply don't have the down payment. Because if you think about it, hey, I found this VA loan that was done in 2021 at 2.75% interest. Well, that's 3 years ago. And that person selling that house is probably going to want 50 to 100 or more than what they paid for it. And they probably put nothing down. So, or even if they did, there's going to be a big gap there. So this person that's wanting to assume this loan, they may have to come up with $50,000, $100,000, whatever the gap is.
Understand.
Yeah, so that's the biggest challenge.
So basically
Which
getting
essentially
their equity.
Essentially, at that point, you're just doing a warranty deed, right? Or are you doing a quick claim deed, or what are you doing with
I don't
that
think
process?
you could do a quick claim deed. I don't think you get title insurance on that.
No, you can't.
It's got to be a warranty deed transfer. There's going to have to be the release of liability. I mean, it's going to be like, again, I've never seen this happen, so I'm totally amateur with this stuff.
Yeah.
But the other thing is that veteran that is letting someone assume their loan, if they go to buy another house with the VA loan, they may not have the VA loan entitlement to buy that next home. So they've got to consider that too. So that's not really.
Does the buyer have to be a veteran as well?
That's what I
No,
was about to ask.
no, and that was another question. The buyer does not have to be a veteran, which you would think they would to qualify for a VA assumed loan, but they do not.
Okay.
Yep.
Weird.
So, I don't know. You can get on a rabbit hole reading up on this stuff. It's if you could get a loan, and I don't know if y'all are able to search the market for homes that have VA loans on it somehow, but that would be
I think
interesting.
you can in the CRS.
If you had a borrower who had funds to put down on a house, that'd be interesting to say, hey, here's some houses that have VA loans. They may or may not be for sale. Maybe you could just approach them and say, hey, would you be interested in selling? And then assuming that loan. I don't know. That'd be, if I was in the market to buy a house, that might be something I would think about.
For sure.
You know,
I think you can in the CRS somehow.
probably.
I mean, there's,
Sounds like a complicated thing for a realtor to do right there.
Little work there, right?
Talking about sending them down a rabbit hole.
Yeah. So we talked about the entitlement and that issue, release of liability. There was a question about ways to access equity. We talked a little bit about this with HELOCs. You know, how do you access equity in a home? Is that something y'all had questions about, or?
That was kind of my question from earlier.
Yeah. So we have this cool program that we started within the last 12 months. We partnered with a company. We actually put our logo on it now, so we're brokering it now. It's kind of branded us. It's an AI-based home equity loan program. We call it a home equity line of credit. Technically, it's paid back on installment payments instead of interest only. So that's the only downside I think there is to it. But it's an AI-based deal where it's an automation value, an AVM on the house. I can get offers. I can get various option offers back within, say, 30 seconds once I submit like 5 pieces of information. So I'll have a client call me up and say, hey, you did my loan a year or two ago. I want to tap the equity in it. And I'll say, well, hey, let's see what might be available. So without even doing a credit inquiry, it's a soft check. I could put in their address, their name, their household income. They want to know whether the house is on the market or not. Usually it's no. And that's about it. And I hit submit, and in about 30 seconds it tells me what options they have. I had a client a couple months ago, I think I mentioned this to you, guy from Virginia. He wanted to pull out some equity and he called me in the morning. I run it. He gets a $200,000 offer on his primary residence. He gets an email automated from me with the options. He could do like a 10-year, 20 or whatever. By that afternoon, he had closed on it. This is a home equity loan. He applied in the morning. He signed the documents in the afternoon. So a notary met him that afternoon. Now that was a Thursday. On Tuesday, he had that loan funded because there's a rescission period with the home. You got to wait 3 days on a refi or on a cash out. So he had $200,000 4 days later. I've never seen a real estate transaction have that fast. But that's the power of technology these days in our business. I mean, it's crazy. AI is changing everything. So
Scared me to death. I'd be afraid somebody comes down on your house now.
I 100%,
You
man.
signed it.
Right. Well, there's a notary involved to verify, and all that. So,
I know
But,
that's just scary.
yeah,
Wow.
it's a scary world for sure. There's a question about, let's see, multifamily versus single-family value. I think Matt asked that. Values are done differently, as y'all know, with single-family residence versus multifamily investment. And without getting too involved, commercial, multifamily valuations, you don't use the sales comparison approach, you don't use the cost approach, you use the income approach. And so you start talking about cap rates and NOI, net operating income, to arrive at a value, whereas on a single family residence, most of the time it's for a 2 to 4 unit, it's going to be a sales comparison. So we're finding comparable sales to support value. In the multifamily space, whole different game. It's all on the income. What does that building generate on an income standpoint? That determines the value. So you can get in the weeds with that stuff, but that's kind of the basis on that. So questions on that? Okay. Everyone's glazing over a little bit from that.
I love
Understandably.
this stuff.
There's a question, common items needed for a pre-approval letter. So this is a good thing to kind of have in the back of your mind. When someone's need to get pre-approved, what are some kind of base level things that someone might need to get pre-approved? Your average person who works a job, we're going to need usually the last 2 years employment history. So a good kind of rule of thumb is 2 years of resident history, 2 years of job history. So, you know, your last 2 W-2s, your, if you're an employee, we're going to usually need the last 30 days worth of your pay stubs. For your money you're putting down or for closing costs, we're going to need the last 2 months of your bank statements. And underwriters look at those. So if there's been large deposits in the last month, they're going to question them. You have to let that money season. So, but just generally speaking, 2 years history, W-2s, pay stubs, bank statements. Those are kind of your basic things. We see a lot of folks in the medical industry these days who are PRN or part-time, or they've transitioned from full-time to part-time or vice versa. A lot of times we might need your year-to-date pay stub showing your year-to-date earnings and how it's broken down, like if there's shift work or if there's overtime, and then maybe the last pay stub of last year. And so there's just different ways to arrive at an income number for people. It's not always cut and dried. We wish it was a black and white world, but it's not.
Cause some people could be like us and be 1099.
1099. So.
Right.
So my ears always perk up if you're contract labor or you're a 1099, then we're going to need your 2 years tax returns. Some of the government loans require tax returns anyway because they want to make sure that we're counting all their household income, like USDA or THDA. But it's always nice when we don't have to have tax returns because it's just one less thing we have to ask the client for. Self-employed individuals, people who own a lot of real estate, that income's going to show up on their Schedule E most of the time, or if it's withheld in an entity. Usually for business tax returns, we don't need them unless they own 25% or more of that entity. If it's less, we might just need their K-1. But everyone's situation is different. The main thing is, hey, last 2 years of your information, current pay stub. If they're self-employed, we would need like a year-to-date P&L. So for that realtor, we want to see like, hey, what's your year-to-date income and expenses? A lot of people don't keep track of that, so we can kind of help them build a little spreadsheet to say, okay, here's income expenses, and we send it for them to DocuSign. So those are basic things. If there's gift funds involved, we need to know who the donor is going to be. We can type up a gift letter, send it to them for DocuSign too. But I don't know. Like I said, every borrower is different. There's so many nuances to someone, what we need as we go along. A lot of stuff we don't know we need until we get into the file. So a lot of times we have clients or agents say, well, why didn't you tell me up front I needed this? It's like, well, we didn't know about it. Or it wasn't until we dug into the file that we knew that we needed this or that. So some clients are kind of like Pandora's box. You just, this can of worms open that.
Like a box of chocolates. You never know what you're
Never
going to get.
Never know. Of course, the application, we want to either do a soft or full credit inquiry to make sure the credit is up to snuff too. So that's kind of general stuff. But it gets more detailed from there. Why would a client be denied? Like, what are some reasons for denial? Well, debt-to-income ratio tends to be one. If we can't qualify their income, and they may make more money than we can qualify them on. Fannie Mae and Freddie Mac and Ginnie Mae and all the investors have guidelines on how we compute their income. And so sometimes the way we calculate it is not reality. We have to maybe use a smaller number than what they're actually getting each month. Maybe they haven't been, maybe their most recent year was a lot better than the year before, but we're having to average that income. That would be a reason. So, debt to income ratio is a huge part of what we look at. There's different tolerances based on the loan program. Probably your most lenient loan is your VA loan with debt to income ratio. We've seen some go up to upper 60% for DTI, which is just crazy. FHA will go up to 56%. Fannie Freddie 50%. And then some of your other, like USDA now is I think 45%. THDA, which is a state bond down payment assistance program, that's 45%. So it just depends on the program for debt to income. But that would be a reason for denial. It exceeds what the guidelines require. credit score. So if there's credit issues, so one thing to know too, like with credit score, is you can have technically a qualifying credit score. So I just had one yesterday. We have a gentleman who's wanted to buy a house, and he's had some credit issues in the past. We rolled out what's called a low FICO FHA loan, where you can actually have 7 to 10 years, been on
Something like that, yeah. So to say something like that just dropped off, is that gonna hit them like trying to?
No.
Is this hypothetical or you?
No, it's not.
If you've got a Chapter 7 bankruptcy that just not.
Asking for a friend.
Yeah. So there's exclusionary periods where once you get, like, say, depending on the loan program. With FHA, I think you got to get out of bankruptcy, the discharge 2 years, I think. Conventional maybe 4. They all run together. So even though it shows on your credit report, hey, and it does show this person had a bankruptcy discharge on such and such date, and you have to actually disclose that on the application. But even if you don't disclose it, it's going to show in your credit report. You can have it. I mean, we do loans all the time for people who had a bankruptcy and it was within 7 years, but because of the 2-year period or the 4-year period, so VA is pretty lenient, FHA is pretty lenient with that. Conventional is a little more strict around that. But those kinds of things can come up where even though their score's okay,
There's other factors.
For example, FHA, if you've had more than 1 or 2 mortgage 30-day delinquencies in the last 12 months, then no go. There's also some things with right, like so. There's some things too with if you can cite extenuating circumstances around certain things, you can get by with some of these waiting periods. It's case by case, but yeah.
It says here your income is wholesale luxury perfume.
Insufficient assets would be another thing. So if borrower can't show the required assets for closing, and maybe they have the money, but that money came in that we can't source. Maybe I've had clients who have $100 grand in their safe. It's like, well, we can't source that.
For sure.
Now, sometimes we can use cash if we can show, well, here's a bill of sale, they sold this on
For
this
sure.
date, we can show the deposit was here, and I had, and we've had some funny situations. We had a client one time who had a really, really elaborate gaming system, and she sold this computer and everything, and we had pictures of it, and we had to go online to substantiate that what she sold it for was actually market, and and so we were able to use that cash. But
Have you ever done a loan for a tattoo artist since they are cash?
I have.
How did you do that? Did they need like receipts?
Actually, you know what? That was the manager of the tattoo parlor. And
Or
they were,
still cash, yeah?
no, I think they were paid a paycheck.
Oh.
Yeah. I mean, if they report it on their, if they're 1099 or if they're W-2.
1099.
If they're 1099 and they report on their Schedule C,
Okay.
then it's like any other business.
Yeah, whatever they.
But are they going to report it? I mean, are they
Probably
going to report
not.
all of it, or even most of it? Like waiters and those are tough industries. Bartender, yeah.
Mhm.
Most people aren't reporting all of their cash income.
Oh, yeah,
You know,
did that for a while.
people don't want to pay taxes, but then they want to
I
get
made
money.
$8 today.
I'm coming up against my time. Let's see. Minimum credit score. That was a question. Minimum credit scores vary. FHA lets you get down to 500. I don't know a lender that'll do that. Like I said, we have a low FICO FHA program. Sorry, I'm not turning this way. Low FICO program that's 580 to 620. So
Just there, don't pay, it don't matter.
yeah. Conventional generally 620. Again, doesn't guarantee you're going to get approved because there could be things in the credit that preclude that. Let's see, USDA is now I think 640, but then again there's a 620 low FICO USDA range. VA generally depends on the loan, the lender, but I think we're 620 on VA. New programs, we talk about DSCR, that's been a bigger topic, bank statement loans, again, self-employed folks who can't show their income on a tax return, but they can show bank statements of 12 or 24 months. We can work with those clients. And then finally, success stories. I'm doing my first 203K loan that I've done in probably, 5 or 6 years. Everyone's heard of the 203K FHA loan. Mm-hmm. It's a renovation loan where you buy a home that needs work. In fact, it probably needs work just to be inhabitable. But the 203K allows you to add the renovation costs to the purchase price and then put as little as 3.5% down of that total amount. So you're essentially financing some of the renovations in with the loan. And there's some hoops to jump through. It's a government insured loan, so you've got to have licensed contractors, all the contractor package and all that stuff, showing they're licensed and insured and all the good stuff. The improvements generally have to be done within 6 months. On a full, I think they're now moving up to 12. If it's a limited, I think it's 6. If it's a full, 12. This borrower I'm working with is only doing about $10,000 or $12,000 to the house, so it's a pretty simple process.
With a max of 30.
No, it actually, the limited was 25 and now it's 75, I think.
Oh, wow.
Yeah, it's being bumped up. So it's loosening up, which is nice. I mean, I hardly ever see them, but they're out there. I mean, but you know, in this time when it's harder for especially first time buyers to get something they like, that's affordable. I mean,
I had some folks that were getting ready to do it, and they were like, well, maybe we could just buy it and then we'll get a construction loan. I was like, huh? Like a remodel loan, a private loan. Like,
getting a lender to
more expensive.
And getting a lender to finance it on the front end, if there's issues, that could be a problem. A challenge too.
Yeah. So that would be the cheapest or most affordable, from what I've seen. Is if there's a meh house, and if I could just have my dream kitchen, it's perfect.
Mm-hmm.
Okay, finance $10,000 into the house, pay over 30 years rather than take a private loan out or whatever, small personal loan.
Yep.
Say a friend had a listing, and this listing in the living room and the bedroom just had plywood.
Mm-hmm.
What would, if we put like just some cheap carpet down, or if my friend put some cheap carpet down?
Yeah. if they're getting a conventional loan, you probably could be fine with that because that's a cosmetic thing. It's
Yeah,
not.
that's what I was thinking. That was my question. Is like, how can I get it to go conventional?
Yeah, I think I've seen us do loans in homes where there weren't floor coverings down at all.
Sweet.
Ugh.
All more
You're gonna have a problem with FHA. I'm dealing with one right now.
For sure.
Yeah, they're gonna make you put floor coverings down. Conventional, that's a cost to cure item. You know, y'all have heard that from Danny probably before in here, the appraiser. If it's a cosmetic thing and it doesn't affect safety, sound, and security, then he would just do an adjustment, a cost to cure whatever that is. So a cost of say $3,000 to put flooring down, and that would just come off the value, and hopefully it doesn't affect the value too much to where it doesn't appraise. But the times I've seen us have to do that, it hasn't. So maybe we've just been lucky. Yeah. Thank y'all for having me. I'm going to wrap it up unless there's another question.
Sir?
Yeah.